In this video, I'll be introducing the various business forms available specifically in South Africa. Different forms might be available in other countries. There are mainly three groups of businesses. A trading business, also known as a retail business, where you buy and sell products for a profit. There are also service businesses, where the business provides a service for a fee. And then there's manufacturing. These businesses manufacture a product to sell. It's important to remember that a business can fall into more than one of these groups and are not limited to only one group. For example, a business could provide a service and then also sell related products. These three groups can be classified as either a non-profit organization or a for-profit business. Non-profit organizations are formed for the benefit of society and human welfare, and any profits made are used to achieve that goal. For example, the Salvation Army, the Red Cross, or the NSPCA. For-profit businesses are exactly what the word implies. They operate for a profit, which is either reinvested into the business or it is paid out to the members. Most businesses fall in this category, and we will therefore now look at 5 of the most common forms of for-profit businesses. These include sole traders, partnerships, close corporations. However, the formation of new CCs are no longer allowed in South Africa. Private companies, where the company name ends with the words proprietary limited, in short, Pty Ltd, and then also public companies, with the company name ending as limited, in short, Ltd. Each of these business forms have very specific characteristics, and when setting up a business, it is important to understand the difference between each form and to ensure that the business form you select suits your business needs and goals. As an accountant or bookkeeper of a company, it's also important to know the characteristics of these forms, as it does have an impact on the reporting and taxation requirements of the business. So let's look briefly at the various characteristics. Let's look at ownership. With sole traders, there's only one owner because it's basically you trading as a business. Partnerships can have 2 to 20 partners. CCs can have 1 to 10 members. Private companies can have a maximum of 50 shareholders, whereas public companies must have a minimum of 7 shareholders to an unlimited number. There is no maximum. And then if we talk about whether these entities are legal entities, with a partnership and a sole trader, no, because it's basically you or the partners trading as themselves. With a CC, a Pty limited, and also a limited company, then yes, those are seen as legal entities, standalone entities. So, who is responsible for the liabilities of the entity? With sole traders and partnerships, the owners are liable for the business debt. But owners of CCs, public and private companies have a limited liability, and they are not liable for all the business debt. Also, let's give a thought as to who control the business, who manage it. Here you can see that sole traders, partnerships and CCs are controlled by the owners of the business, whereas private and public companies are controlled and managed by directors who were appointed by the shareholders. Next, let's talk about capital contribution. When we talk about capital contribution, we are referring to the assets or funds contributed to start the business. When starting a sole trader business, the owner contributes the capital. With partnerships, all the partners can contribute. Also, all the members can contribute to a CC. But a private company will issue shares privately to raise the capital, and a public company will issue its shares publicly to raise capital. Another important aspect to consider is whether the business will be able to continue if one of the owners die. In short, for sole traders and partnerships, the answer is no. With sole traders, it's obvious that the business will come to an end. It is the owner trading as the business. But even partnerships come to an end when a partner dies. And then the remaining partners have an option of forming a new partnership. However, CCs, private and public companies, will continue to exist if one of its members or shareholders die. Now let's also take a look at the tax obligation of each form. With sole traders, the owner pays income tax on the profits received from the business. Same with partnerships. The partners pay income tax on the profits received. But with CCs, private and public companies, the company pays corporation tax on the net profits of the corporation. That concludes this short introduction into business forms. If you find this video helpful and would like to see more, please like and subscribe our channel below, and feel free to share this video with anyone who might benefit from it. Also, if you subscribed and would like printable clips of this video, please just ask. I don't mind sharing.